Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk value investing with Toby Carlisle, principal at Acquirers Funds. As a student of value investing and market history, Toby offers up some perspective and optimism as to why value investing works and why it can pay off for those who are patient and understand the ups and downs of buying cheap stocks. We also talk Buffett, Toby's new book, the downside of chasing the hottest investments in the market, and much more. As always, thank you for listening. Please enjoy this discussion with Toby Carlisle of Acquirers Funds. Hey Toby, how are you?
Hey fellas, good to see you.
Thanks for jumping back on with Jack and I.
No, my pleasure. I love chatting to you guys. Fellow value sufferers, long value sufferers.
We could share our pain.
The commiseration session.
Yeah, or the complaining bitch session. We need someone to talk to.
Yeah, it's been such a rough run for value. I feel like maybe it's turned the corner a little bit, but then I probably would have said that a few times over the last decade too, and been wrong.
Yeah. You know, I don't know. I kind of am looking for, I wrote an article like a couple weeks ago, like sort of just asking like what the catalyst is going to be, or does it even need a catalyst? Maybe that's the better way to try to think about it. It seems to me like when I think back to times where value has really ripped, there seems to be like something I can like look back to that sort of stands out a little bit to me. And I'm thinking in this market, it's hard, but you could, and it doesn't look that way based on what the Fed's saying, but if they start to lower rates, I mean, maybe that's the catalyst. I don't know.
Yeah, I think that value has tended to be an early cycle strategy. It tends to, I just think that people tend to sell out of value stocks because they're scared of them, or they tend to be the more cyclical, less good businesses, and you're kind of making up for that because you're buying them at a big, deep discount, a deeper discount than they are worth. Like you're handicapping to buy them, and so anything that survives through a big drawdown comes roaring back when it's all clear, which tends to make value an early cycle. And then on the other end of the cycle, when everybody's bulled up and fearless, value gets left behind because it's the story's not very interesting, so it lags at the end. And so I think that a big crash is usually a good start for value. And I think when I look back at the performance of my stuff, I think that the outperformance started in late 2020 or early 2021, which would have been, it wasn't really I guess there's been a little bit of there's been quite a big bust for the techie names, but I don't think really the rest of the market has been busted. So maybe it was like a localized bust for the really egregious, like the Zoom like things at the peak of the market. And maybe that has been, but I've said lots of times that I think that you can really only tell when it's outperforming. Like you don't even know until 3 years later, or years later, because you're always expecting that next leg down, and eventually it just doesn't come. When you go through a proper bear, like a really long-term bear, like a 2000, 2002, 2007, 2009, when there are like 14 or 15 or 16 lower lows, each time it kind of rallies, you think this could be this might have been the bottom, and then it gets to the point where it just breaks your heart. You just don't care anymore. And of course, that's the rally, but you don't trust it until years later you look back and that really was the bottom.
Yeah, you have to enjoy torture to some degree to be a value investor, because it's like these big spurts, these quick spurts followed by these long periods where it doesn't work. Like you have to be able to, it's tough for, when we have clients doing it, it's tough for investors to sit through that. But I mean, that is, if you look at the history, I mean, that is kind of what it looks like.
Make pain your friend. you got to get used to underperforming. Like if you don't like deviating from what the index is doing, value's not for you. Just buy the index, because there are very long periods of time where you deviate and very short periods of time where it outperforms. It's just that when you add up all of those short periods, the spurts of outperformance, it does seem to add up to outperformance over the full set, even though in time, most of the time, I think you're underperforming. And the other thing that you have to do is buy stuff where everybody in the market knows why it's cheap. And you're the only guy out there, well, not the only one, but you're one of the few who's prepared to buy this thing when it's all beaten up. And then like half the time you're wrong and the rest of the market was right. And so you just feel like an idiot every time you put one of those positions on. Everybody knows why it's cheap and it turns out they were right. It's just that in that small, I think it's like 50% for me. It's literally 50%. Those 50% when the expectations of the market are wrong and they kind of turn around against all logic and reason, and what the market expects, the outperformance is so great that it sort of makes up for the fact that you're wrong half the time.
What do you think about the comparisons between what we're going through now and like 2000? At a high level, the spreads are actually pretty similar to 2000, I think. So that might be a parallel, but the absolute valuation is not as low. I think this like small cap value is much cheaper in 2000, but we did have kind of a tech crash here, just like we did then. And what do you think about the comparisons between the two?
It's been such a funny period of time, because I would have thought that we had that giant bubble 2020, 2021, when all of that stuff was running really hard and everybody else was getting left behind. And then I thought that the crash that followed that, which was sort of like all last year, I guess, I was really expecting the tail end of that to be a big sell-off. And to be fair, we are still well below the end of 2021 peak, beginning of 2022 peak on the index. It's still low. We still haven't recovered it. Even though technically somehow we're back in a bull market, like they measure the bull market from the low, 20% on the low, and it's a bull market, and CNBC will tell you it's a bull market, and then you look at the chart and we're still below the old bull market peak. So I don't really fully understand how that works, but that's the technical definition of it. So we're back in a bull market. It doesn't feel like much of a bull market to me, but we didn't see that extended period of value outperformance like we did in the early 2000s. And now we're back into this weird thing where it's like 7 names are generating all of the outperformance for the index this year, and the other 493 names are not. And if you look at the equal weight, the equal weight's really not done much of anything this year. It's participated on the downside, not really participated on the upside. So I think that's probably closer to the average experience, unless you're someone who owns the index, which has traditionally been, longer term, you don't really want to be in the market capitalization weighted index. You want to be equal weight should outperform, just because it's sort of more like a value tilt. But it hasn't worked. I don't know why.
Yeah, I almost wonder if, to that 2000 period, I wonder like how much passive investing sort of, influences like where we are today versus where we were then. And if you still have like the Mike Green argument, with like everyone allocating all the 401ks to passive. I mean, if you go out and talk to your average investor right now that's in a 401k plan, they may have a value. They may have like one value fund, but everyone's in these target date funds and stuff like that. So it's like, I wonder with the flows and market structure, and then the other thing that comes to mind is, wasn't it David Einhorn who was on Patrick O'Shaughnessy's podcast, who was like,
yes, he
was basically making the point that like, he's kind of moving away from, and Jack, you kind of know this maybe a little better than I do, but the sense of it was that he was kind of giving up on like investing based on fundamentals and just wanting to buy like companies that are buying back stock or buying or paying a dividend, like getting like some return, because he doesn't want to wait for the market to realize their.
Right. He was talking about giving up on like that the market's going to revalue these companies. He was trying to find ways. He was getting cash himself for investing, buybacks or whatever, and saying he was kind of not using as his primary thesis anymore. The market's going to see things my way and is going to revalue these companies.
I mean, that makes me want to be a value guy even harder, if that's possible. if Einhorn, who's like one of the great deep value investors, is pulling back, then the contrarian in me says, what a great time to be a value investor. If you buy something cheap enough, it's not the performance of the stock price that generates the returns for you. The returns are embedded in the underlying holding that you buy, and you get reinvestment and you get flows. If you buy something cheap enough on a cash flow basis, you're getting some form of reinvestment and you're getting some form of flows in that business. And I think it does eventually show up in the stock price. It doesn't bother me that it's not immediately reflected in the stock price. I know that he did say that, but I'm sort of surprised that he did, because it's just it's not the way that it works. I don't really care what the rest of the market thinks about things that I own, because my return comes from the fundamental performance of that business. And the cheaper the price that I pay for the fundamental performance of that business, the better my returns will be, whether the market recognizes it or not. Because you will get growth in the underlying business, and you will get flows out of that business. And that's where your return comes from. It's not the price performance that goes on top of that. Having said that, if they do buybacks and other things, then that will, me buying and the company buying back stock at a big discount will concentrate the performance for my shares. So that's a good thing. I also like to see them buying back stock for that reason. It's a funny, I don't know. I think a lot of the value guys have had this path where they've gone traditional deep value, and that's been really beaten up for a long period of time. And then they've become macro guys, which is Einhorn's path as well. Very macro, gold buggish and so on. And now completely abandoning fundamental investing. I like the sound of that. The contrarian in me really likes that. If you look back at 200 years of data, which Michael Samanov did, stitching together lots of different data series, you can see that there are these periods of time where value really gets beaten up. Now, this might be the worst one in the data, but so what? Momentum had a really bad drawdown after the 2009 crash. It was down like 90%, looked sort of brokenish through that period. But I think that it's looked pretty good since. It's probably been the best performing strategy, and I suspect that's what will happen to value. That the moment everybody sort of abandons it is the moment that it comes back to life and just surprises everybody. I don't think that I'm saying that like it's not pure hope. Like I can see it in the data. I can see where we're getting very good values for the things that we're buying. Although I do acknowledge, just to go back to something that you said earlier, there is the early 2000s, the opportunity set for value was probably better than it is now, because the value stocks were the higher return, the higher quality companies, whereas they are less good now, but you're also getting a pretty big discount for them. I think value, when I look at the value opportunity set versus the index, I think that it's hard to see how value doesn't outperform over the next 5 or 10 years.
Yeah, if you look at spread data, obviously, the value businesses are still doing well. This is multiples are going up on the growth relative to value. That's what this is. This is not a function of the growth businesses are necessarily doing better. So if you believe fundamentals matter, you would expect at some point we see a reversion here.
Just before we came on we were talking about this, that it's very, very hard to know where the bottom is in a strategy in real time, because you see that leg down after leg down after leg down. You don't know where you are really in the cycle. Just bottoms are impossible to pick. So at tops, it's just hard to know where you are. Can the market become more irrational when it's already very irrational in both directions? Clearly it can. We've seen it happen lots and lots of times. It's my total expectation that that's what's going to happen. I find this on Twitter too, and I'll say something on Twitter and I get some pushback from guys, and it used to bug me a little bit, like years and years ago it used to bug me. But now I realize we're talking on different timelines. Like we're completely talking past each other. There are lots of guys out there who are essentially momentum or relative strength investors. They're buying something that's been working. They're in NVIDIA because it's been working recently. And they don't really care what happens to NVIDIA in 3 years' time or 5 years' time. They're in it because it's working right now. Whereas I'm a value investor. I look at where the value is, and it's too expensive for me, and I don't care about the near-term price performance. And my time frame is longer because I think the short-term stuff is just noise. It's just way too hard to predict where something's going to go in the short term. It really is a coin flip. And after fees and trading and taxes and all those other things, it's worse than a coin flip. Whereas if your time frame is long, and I think long is like a year these days, but 1 year, 3 years, 5 years, and you can be a little bit calmer about what's happening in the stock. You can give it some time to turn around, because you just think about the reporting for one thing. If they're in some trouble, and you see a bad print, they're already halfway into the quarter when you see that bad print. Just because the delay in the reporting. And so it just takes a long time for these things to turn around. It takes quarter after quarter or year after year to see a good turn. And so I think you've got such a massive advantage if your time frame is just longer than everybody else. And I think that the longer you do this stuff, the longer your time frame should get, because I've seen enough things now that I think that what people get frustrated that they don't turn quickly enough. They get impatient. And I think the best lesson is that Dillard's, I forget which one of the Buffett's lieutenants it was who held it, was Ted or Todd, who had held Dillard's. And he held it for 6 or 7 years. And it was in my screens all the time, and I've owned it on and off as well. But, just didn't do anything for that period of time. And then at the end, he had like a 10-bagger in a couple of quarters or a year or something like that. And so his compound annual growth, or his internal rate of return, ended up being like 36% compound for the 7 years that he held it. But all of the return was in the last year. And so he really had to believe in the fact that he was able to do some pretty good fundamental analysis and understand what was happening in that business as they bought back stock and they rationalized the business and they did all those sort of things, which finally turned, they had a little bit of luck there with COVID and a few other things because they were battening down the hatches. And they got a little bit lucky, but that's the nature of investing. You get some bad luck and you get some good luck, and he got some good luck at the end, and that's why it turned out to be a great return. So I always keep that in my mind as the model for these things. Don't worry necessarily about how the market views the equity. Like, I'm already in it because I think the market's being irrational about the equity. Why would I expect them to become immediately rational after I buy this thing? I shouldn't. I should expect the irrationality to continue, and provided that the underlying financials are sound and it's going in the direction that I like it to go, then I should just be patient and sit there and let it happen. The opportunity probably gets better.
So what's interesting is we were like rebalancing into like the COVID crash, and we bought like Signet Jewelers. It was like, and it was like, at the time it was like jewelry stores are good. And this, because we run quant strategy. So I was like, oh no, we're going to get so smoked on this. Cause we've gotten smoked in plenty of retailers, by the way, and they do behave like that. They do nothing or they go down, and then like one good earnings report and like Abercrombie and Fish is up like 40%. Just because it's right. And then it's like top of the charts and then falls back down. But Signet was like, I don't know what we did, but it was a huge winner for us. But we hadn't held it, but that's like a benefit of maybe, rebalancing or having a systematic way to rebalance, especially value into those periods, because your system's going to go and try to get you in the, depending on how you're running the value, but trying to get you in the cheapest stuff, I
mean, it's such a great point, and it's one thing that I have learned as well, that I'm just as subject to all of those same. I understand what the narrative, we're in the market all the time. I'm on Twitter all the time. I know what everybody thinks about all of these other stocks. I know why they're cheap, and I know why it's dumb to buy them. I just look at the value, and I think if the expectations in this thing are so low, they're so poor, that really all this thing has to do to surprise to the upside is like just keep on doing what it's doing. It just has to be there in a little bit. And they turn around all the time. I have this little exercise now. So, my co-host on Value After Hours, my friend Jake Taylor, has Journalytic. And Jake said to me a while ago, you should take your names from a rebalance and put them into Journalytic and then write down how you feel about them. And this is my discretionary feeling about them. I'm not going to override the model. I'm just putting them in there. And I'm a bearish negative guy. I go through and I'm like underperform, market perform, underperform. Like that's a lot of the ratings that I give these things, because the narrative impacts me as well. Mm-hmm. And I look at them and it shouldn't be a surprise, but it continues to be a surprise to me, even though I've been doing this for a long time, these rebalances, and looking at the names that go in and thinking, this is a bad rebalance. This is ugly. And it's always that those are often the best rebalances, because I know the narrative, everybody knows the narrative. It's just that they're so cheap that any little hiccup in their fortunes and they're back and they're racing and they're well up. And I can't predict it. Having done it for so long, probably I should just fade myself. I should just Costanza myself and just flip my ratings around, because it's the things that you least expect to work are often the ones that work the best.
It's funny, like as a value investor, if you ever look at your rebalancing names and you love them, there's probably something seriously wrong.
True.
If you're ever looking at I'm always looking at them like, why are we buying this horrific company? Like, But we're on average, it tends to work out, but they're never the names you're not going to be buying Google in there very often.
Every now and again though, like because I have to go and talk about the names, to promote the funds, I go out and I talk about the funds, but I can't talk about it's just too abstract to talk about the strategy. We're trying to buy really cheap stuff. They tend to be beaten up. You're going to look at these names and want to be sick. That's the reason that I wrote Deep Value 10 years ago now, because every time when I was running managed accounts, people would look at the names and they'd say, what are you doing? These are all really bad names. And I'd say, that's the strategy. We're buying really bad names. And they just think, this guy's out of his mind. This guy's a lunatic. So I wrote a whole book about the fact that you buy these things that are ugly. And everybody knows they're ugly. And all the smart guys know why they're ugly. But that's why they're cheap. And you get this, that they defy expectations is how they generate the returns. I think O'Shaughnessy Asset Management had that pretty good chart that showed the performance of the glamour or the growth or expensive or whatever one you want to call those portfolios, the performance of the earnings in those portfolios versus the performance of the earnings in the value portfolios. And they found that for the most part, the earnings in the glamour portfolios actually went up and the earnings in the value portfolios went down, which is what you would expect. It's just that the multiple in the glamour portfolios, they were so expensive that they would just come down to sort of not quite as expensive, but that drop in the multiple more than outweighed the increase in the earnings for a net loss in those portfolios. And in the value portfolios, it was the other way around, that even though they did kind of decline a little bit across the holding period, the earnings declined. The multiple expansion was so great that it outweighed the earnings decline, and the portfolio as a whole went up. And so glamour tends to slightly underperform, value tends to slightly outperform. Most of it is multiple, but it's expectations as you go in rather than sort of the underlying performance of the stock that drives the returns.
Yeah, that's been one of my biggest lessons in investing, is this whole idea of expectations versus reality. And it works everywhere. It doesn't just work in value. Like right now, everybody's trying to predict inflation. What is priced in for inflation, and how can I have a divergent opinion that's more correct than what's priced in? I mean, that's what you have to ask yourself with everything. It's always like people think, well, growth stocks are great companies and value stocks are terrible companies. Well, that's what's priced in. So how is that going to diverge when reality comes in? I mean, that's everything with investing.
Yeah, I think so. I think I was halfway through. So I do as I'm promoting these things, the thing that I sometimes I find in there. So I found Meta, when Facebook, I found Meta when Meta kind of came in, it was quantitatively cheap, and I thought that was a pretty good bet to turn around, and it did in fact do that. So occasionally, like I think you can sort of see that something's going to work, but I think that's an unusual one where Meta was a very good business with very good cash flows and a plan to buy back stock. And I think the narrative around why it would work was something like they'll just turn off the metaverse spending. Do you guys remember the metaverse?
That was yeah, I remember that.
18 months ago. That's what
Are they still doing that, by the way, or they just backed it down? Or
stopped talking about it? I don't know. I think they turned the metaverse money into buyback money and the stock came alive. Zuck's still in there. It's so funny, like the narratives that drive these things are so short-lived that you get the metaverse for a while, and now it's AI. Like you can't go on a conference call now without hearing AI. It's like they're trying to fool the algorithm or something. If they say AI enough times on the earnings call, it'll pop up on some quant screen and people will buy it for that reason. And I'm sure that AI will, in 18 months' time, AI will not be the headline. It'll be something else. Probably it'll be, what a nasty bear market, and will the market ever rally again?
Speaking of buybacks, it's like, and maybe I'm sort of rose-colored glasses, because like for me, I feel like, and it kind of goes to the Einhorn thing a little bit, but it goes even back further to like Buffett and Apple. And one of the key things that he said when he first started buying Apple was, this company, I don't know, they had like, I think it was $100 billion approved buyback or something like that. And I think the market cap might have been, I don't know, they might have been around something, maybe around 500 or 600 billion, not a $2.7 trillion company. But, that it seems to me that, and we had Cole Smead on the podcast, and I think we asked him like the most important sort of signal. And it was like management buying back stock and also like buybacks. And it just has like raised, I guess, like and to your point about Facebook, like, now they have this buyback program, and it seems like the stock has woken up. It seems like that's a pretty powerful signal because of the mechanics of what it actually does.
Meb Faber wrote a book a few years ago when he was launching his shareholder yield idea, and I think this is a few years ago. This could be, I don't know, I've been in the market for too long, but maybe it's 7 years ago or something like that when that first came out. And one of the things he talked about in there was the materiality of the buyback, because there are lots of buybacks all the time, inexpensive stocks.
Mm-hmm. Right.
Managers with lots of money coming in love to do buybacks in expensive stocks fueled by debt, which is a terrible idea and gives buybacks a bad name and makes everybody hate buybacks, including politicians and so on. Net buybacks are bad for the stock market because managers are just as subject to the same thing that the rest of us are, where they just overpay for stuff. But when the buyback is material to the value of the company, that tells you a few things that are interesting. One of them is that they have this sort of cash flow or cash position that they can do material buybacks relative to the market capitalization. So it must be cheap relative to the kind of size of the business that they have in there. And then it tells you also that management, is actually sensible and aware of the fact that there is that they are cheap and they've got the financial resources to do it. So those three things are pretty interesting pieces of information. The stock is cheap, management is aware of it and is doing the right thing, and they have the resources to do it. Like, that's basically all of the things that I'm trying to do when is it cheap? Is management good? Do they have the financial resources to survive whatever's coming? And so it answers those three questions in one, when it's material, not when it's, marginal and just trying to goose an already overvalued stock.
One of the other interesting things with Meta that I think was maybe different than like 2000 with a lot of these tech companies is these are better businesses, and they also have way too many people. And so they were able to pretty easily say, all right, we're getting rid of 20% of the employees. We're going to improve cash flow. Like, it wasn't difficult to do because they had just overstaffed themselves. And, I guess some people credit Elon at Twitter with setting the tone for these companies, but a lot of these, at least the big tech companies, have been able to do that and basically not impact their business too much.
That's definitely I was sort of aware that was a thing, that they had all overhired. What do you think the reasons were for that sort of overhiring were? Were they predicting like a whole lot of growth, or did they think that it was like the bigger my domain is, the more important I am?
Yeah, I mean, part of it is probably just because they could, I guess. They were doing so well, and they probably had, bigger growth plans. And you mentioned the metaverse before, like they were, but Meta specifically was that in there. Go ahead, Justin.
I think it was the whole Silicon Valley mentality, which it went all the way from like those, like the Facebooks of the world, all the way down to like, the startups that were funded. And it was like, we don't have to worry about profitability. We almost had this endless amount of, in the VC world and the venture world, it was like these companies were just raising money, I don't know, $1 billion valuation, but they had like 10 million in sales, and it was based on some projection and so I think it just was like rampant across the valley with like just people buying or staffing up when we kind of could do the same amount of work with like 50% of the engineers, something like that. It was like a cultural thing,
It was that period of time where there were all of those TikTok videos where it'd be somebody waking up and having this really leisurely start to their day, then getting into the office and like going immediately to the meditation pod with their free coffee. And it went on like that. There's no sign of any work being done all day.
Meditation. Well, that might be it, because they were doing yoga, meditation. They had free lunch. It was like, nap rooms or whatever.
And then after the fact, there were all of these people who came out and said, I had nothing to do. I was earning like 180 grand a year and I wasn't doing anything.
Well, or they were doubling up, working at two places. The other thing is we all kind of went through, this was my thing with, and it kind of had to do with Silicon Valley Bank a little bit too, but and we had some friends and knew some people that were building sort of fintech companies during the, let's say 2015 to 2020 period. And it seemed like money was just easy to get and flying out of the air. But I continued to go back and ask myself, like, we've kind of seen this before, 98, 99, 2000. Yeah. If you hadn't lived through it, it's hard to see, but it was always like, how are these, and I'm not talking the Facebooks of the world. Now I'm kind of getting more into the startup realm. So we're getting a little bit off, but I was always asking, like, and Jack, I know you were too, like, because we had some pretty deep discussions with a couple of these companies that were, talking about some strategic stuff with, and it's like, what is the runway to profitability? How are you going to make money? And it was always like, I will figure that out later. We're just in growth mode or whatever it is, scaling mode or whatever you call it, user acquisition mode.
We should have launched some sort of tech thing through that whole period. Got that $1 billion valuation, flipped it and sailed off into the sunset.
Well, I was telling Jack, I mean, we had the Validia platform. We could have gone out and raised a bunch of money.
We could have made it happen.
Fintech, maybe too tied to the real world. You need something more esoteric.
Yeah.
Look at things like, it's interesting to go back, having lived through it and talked about a lot of those names as they were, in real time. All the podcasts that I did through that period are still out there. You can go back and have a look at all. I didn't know that who knows really? It was just a different kind of world to what we were used to, where everything was, anybody who was in these things and had projected that, the more aggressive you were about your growth projections, the more likely you were to stay in these names. And anybody who had any sort of fear or skepticism about their ability to turn those into businesses just didn't participate, just sort of missed out on the whole thing. And that's, as a value guy, I'm pretty skeptical about business is tough. Businesses fail all the time. Good businesses fail all the time. So it's hard to get your mind into that new world where everything's just going to grow to the moon. And now if I go back and look at some of those charts, it's amazing to look at Peloton or Beyond or Zoom or Naked Wines, which was like the value guys were all in Naked Wines too, which, that's all of those names have come off like 75, 80, 90%. And some of them, there really is no floor. They're going to be complete donuts. So like Blue Apron, virtually a donut. All of those things, like it seems like a bad dream. Like everybody's woken up from a bad dream, and all of these names that were once multi-billion-dollar companies, $100 billion companies are just worthless. Extraordinary, really.
It's been interesting for me to watch how quick the pivot was from growth to cash flow this time. Like a lot of these companies can't do it, so they're not going to be able to pull it off. But I thought maybe that is somewhat of the hangover from 2000. Is like even the VCs. Like I listen to the All In pod sometimes. Like these guys went from like growth to cash. It was like one episode, and it was like every company must now focus on cash flow. From like every company must now focus on growth, and it's like I mean some of the companies just aren't going to be able to do it. But it is like they changed it. They like flipped on a dime.
Well, I think that's true. And there were guys out there like Josh Wolf, who I think is one of the better VCs out there, one of the more sensible VCs out there. He, very early on, and I can't remember exactly when this happened, but it's more than a year. It's probably closer to 2 years. He came out with a tweet or a blog post or a few things like that where he said, this is what you have to do now, like batten down the hatches. You got to cut unnecessary expenses. I think this was the advice that he was giving to his investee companies. He's saying, the world has changed, and the faster you recognize that the world has changed, the more likely you are to survive what's going to come. And I think that people were kind of like, come on, it's not that bad. But now, and I don't think we've even really seen the worst of it yet, because I do think there's still a lot of VC floating around. And this year, again, because they've had some, NVIDIA coming back and all of the AI and AI startups. And then a few of these, I think there are some, again, like crazy kind of IPOs that have got away at crazy valuations that I don't know how. I'm amazed that people keep on coming back and buying these things, having look at the recent experience in these IPOs. I've got a friend who says that IPO stands for it's probably overpriced, and I always say probably's not hard enough. It's not enough. It's perfectly overpriced.
I was going to say POP, probably perfectly overpriced. Yeah, instead of IPO. There you go. That's but was it? So I'm just trying to think back. So it was the way it shook out, right? Was Fed started raising, sell off in public growth stocks, and investors demanding like profitability or a runway to and then that sort of spilt over to VC, right? That was the flow, just from a historical.
Did the Fed raise before the tech crash?
That's what I was.
No, I think it was the potential of the Fed raising or something. So it was late 2020, right? So it wasn't like the Fed had started embarking on the higher rates. It was like they were just verbally. We kind of saw it coming because inflation was starting to really come in hot, right?
It's funny that we can't remember this having been but my ARKK, the Cathy kind of complex, which I kind of think is that every single tech boom has its emblematic kind of go-go mutual fund, like the 60s, the go-go mutual funds and the gunslingers, and then there were there's probably something in between I'm forgetting, but the 90s had Janus.
Janus 20. Jack still owns that.
Do you still?
No, I never owned it, but does it still exist? Is it still there? It probably is, right?
I think that it has survived. I don't know I don't know which one of them it is, but there is one of them is still there. But they had, they had that thing where they were in all of these little growth names, and then they were getting the flows and then reinvesting those flows back into those little growth names, which pushed them up, which made their performance look good, which helped them raise money, which meant they put more money back in. And it was that virtuous circle of, or not vicious cycle maybe, of money like being jammed into these little names and making the performance look really good. And I think to some extent that's what happened this time around, but with ARK, where ARK was the beneficiary of the flows and then the performance. And Kathy was in these things that, as a fundamental value guy, the narrative part of it is sometimes it's a little bit beyond me. I don't really understand. And I was confused through that whole period. I just didn't know, like, why is this thing more interesting than this other thing around here that's been around for longer and has more earnings and cash flow? And clearly, ultimately, it wasn't. And it was just a flow thing where she was getting the flows, she was investing into these things, and that was pushing them up, which then made her performance look good, which helped her raise more money to put back into them. And then, of course, that reverses course. Although it was extraordinary that for a long period of time there, even after the market was coming off pretty substantially. So that was February. She topped out in February 2021. That was the peak of her performance, which I don't know when we started raising rates, but I feel like it was later than that. I feel like the raising rates thing has only been a fairly recent phenomenon. It's only like the last year or so.
Yeah, I think you're right. I don't think they were raising at that point when it peaked out.
It is funny because it took until after that to sort of get stuck into it, and it was kind of coming off a little bit.
So yeah, this is from a Barron's article. So in 2000, the Janus fund had 50 billion in assets, and the Janus 20 had 38 billion in assets. So if you think about back, 2000, 50 billion and 38 billion. And then in 2017, it looks like Janus merged both of those funds into the Janus 40 and the Janus Research. So however they split up the assets, but they were huge funds, and then they obviously, to your point, investors piled in at the peak probably, and then, it was dead money for a long, long time.
Which I think has what also happened to ARK, that investors piled in, but there was like reflexively buying ARK for a long period of time after the performance had come off pretty substantially. I think there was a Twitter account that used to track it a little bit that showed, and it's not really fair to blame the manager on the cash on cash performance, because they can't help it if they get all of it. And that's what's going to happen. You get all of your money after your long period of performance and you redeploy into your strategy. And so you're sort of inevitably going to tear up the bulk of the money right at the very top, because the other side is all the money getting pulled away from the cheap stuff, which was what we were experiencing. The tide was going out for us when there were lots of really good opportunities around. And so that's not really something that the manager can control. But I think that she's like cash on cash. She's definitely torn up more money than she's made through there. But for a long period after, and this was something that I used to comment on for a while, that at least a year after the peak, the February 2021 peak, so it would have been like well into 2022, they were still net positive in terms of flows. They hadn't had the negative flows, which I think is a little bit of a, going back to sort of Mike Green's argument and other, just people have observed that buy the dip mentality, that's really the only behavior that has been rewarded for the last decade or so. The people who were most prepared to aggressively buy the dip when it recovered to a new all-time high were the ones who had the money around, and that's just been hammered in now for like a decade or more. So I still think there's a lot of dip buying behavior, and it sort of looks like it's been rewarded a little bit this time around too. We haven't really seen the end of this yet, I don't think. I think we'll see it sometime not too far away.
Yeah, the buy the dip worries me a little bit from the perspective of, like, does that mean because everybody's succeeded buying the dip, does that mean when the dip finally comes that can't be bought, it's going to be like a lot worse than it otherwise could have been? I don't know if I have any data to back that up, but it just worries me in the back of my mind.
I think that's what's going to happen. I think that's what happens. Anybody who's like a little bit risk managed or skeptical or hedged or diversified if you've owned anything but the S&P 500 and reflexively bought the dip, you've underperformed. And anybody who's done that that's where the bulk of the money is now. And so those are the ones who are biggest setup. They have the most evidence for why their strategy is going to work, and so they're going to aggressively buy all the way down. Whereas being diversified, that's hurt, but it's probably going to be a better way to live for the next decade.
Are you doing anything? I'm interested in your thoughts, and if you're doing anything with ChatGPT, are you using it like for work-related stuff at all, or have you played around with it? And what do you think? And then also, do you have any? And maybe you've talked to someone on Value After Hours. I'm not sure. We've had a few guys on Excess Returns that have talked about AI and some of the things with like investment strategy. And actually, the guy Doug Clinton from Deepwater, he's Gene Munster's sort of partner. They're like tech guys. He's written some pretty cool stuff on creating like indexes and stuff using AI and so just where are your sort of thoughts on that stuff?
I subscribed to ChatGPT for a few months there because I really do think, I run a very lean organization. There aren't a lot of people here. There's just me. And so the way that I do that is by automating and systematizing everything. I run Google spreadsheets drive a lot of the back end of the business because that's, you can code a little bit into it and you can pull in data externally, code it up, manipulate it, have an output, and then make decisions on the basis of that output. And anytime I find something, I think rather than me going and hunting this bit of data down all the time and manipulating this, I'll spend a little bit longer and build it into a spreadsheet that automatically updates so I can go in and check and look and then have a dashboard that pulls all of that into one dashboard so I can see it all together at once. So I think I'm the perfect person to like really take advantage of ChatGPT. And I love the idea of creating little bots that'll go and do all of the more mundane tasks. I would love it if you could get to that point where, there's a lot of administration and compliance in the back end of the funds. And so to the extent that I could get a computer to do that I know it's going to be basically foolproof, it doesn't make a little transcription errors that humans make, those sort of things. I think it would be awesome. And I would be an early adopter and a user of that stuff. Just ChatGPT doesn't have that functionality yet. It doesn't quite get there. And so then I thought, well, I could use it to write articles and things like that. But the articles were just garbage. The articles weren't good enough. And then, we've subsequently learned that there's a lot of plagiarism maybe in those articles. So that'd just be fatal. You can't have ChatGPT writing an article and then find it's just plagiarized that from somewhere else and me present that as like something that I have written. I just found it didn't write very well. I've written some books, and so my early books I just wrote to, I went to law school, I've written and I worked in a law firm for a decade. And so I have been trained to write at that kind of level, which is like a technical, professional kind of level, but it's just not readable to the average human being. And so I got interested in...
I think everything that you said is accurate and fair. I tend to use it more as... It's definitely a productivity thing for me. So, there's plenty of examples, but I think like if I ask it, it's sometimes a good starting point for me. If I want to write an article and it's a creative theme of tying two things together, I can give it a good enough prompt to help give me like a wireframe. And then I have to go in there and take out all the not filler words, but like the words that like, you can clearly tell this thing was written by like ChatGPT because it's like overboard, it's too enthusiastic, it's too, is whatever those words are. And then I try to sprinkle my own. So for me, it's definitely helped me in terms of like content creation and also giving it pieces of content and sort of summarizing it. I was using it a lot for YouTube videos where I was sort of extracting the transcript and then kind of summarizing it that way. If I want social hashtags to be created, these are just standard things that they're really just, like you said, they're things that an intern kind of would do. Like if I was giving an intern an assignment, which to your point, and here's a play on numbers, like our company's 100% bigger than yours, Toby, just FYI. Because we have two people. We have two people. You have one. So, anyways, there's not a lot of interns running around here. So I'm trying to find different ways that I can be productive with it. So, but one of the things that I just, and I can this would be my critique on the investment side of it. Tell me what you think. It's like, I feel like if someone's using AI to construct a portfolio or an index, it just seems like a big exercise in basically back testing and data mining to me. Because if the algorithm is basically being trained just to look at the best performing stocks. Now, I do think with like ChatGPT, the one thing I think that, or through some of this technology, the way someone's defining what type of stocks they're looking for, and then letting the technology go and seek out those stocks. But however it's utilizing or looking at the data, it seems like it would be just mining that data to find the best combination of holdings. And so therefore it's an exercise in data mining. Is that making sense? Am I right about that? Or
that's my instinct too, that the humans have data mined. It's a finite, data set that everybody's got access to the same data, and everybody finds exactly the same things in that same data set, which is basically all American data from 1963 point in time. And then I think there's more recent stuff from the rest of the world that basically rhymes almost exactly the same to the American stuff. It's not that I don't think that it's really. I don't think that investing really has much more to go in terms of like finding fundamental things that we've missed out on in the past. I really think that the disconnect in investing is the implementation behavioral side of it. That is the thing that is, value doesn't work because nobody knows about value. Everybody knows what value is. It's when you run the screen that has generated the value returns, whatever it is, price to cash flow or something over the last 50, 70 years. And then you look at the names that are in it. You say, there's no way in the world I'm buying those names. Like, for sure this time, this portfolio is not going to work. Or you see that there's all of these, you imagine when you're buying cheap on a price to cash flow basis that you're getting this cheap stream of cash flows, but in almost every single instance, it'll be because there's some question about the firm's ability to generate those cash flows into the future. The advantage that the quants have is that they know that is why it's generating those returns. So they can say, well, we'll buy this thing, trusting that whatever kind of magic happens in the back end of this thing, that the mean reversion or whatever it is that makes these things work, we anticipate that will continue to work into the future, and to the extent that it doesn't, it won't work. Whereas if you're a discretionary investor, you look at a lot of those names and you'd say, this is just not going to work. I know why this thing's busted. I know why it's broken down. So that value as a philosophy perhaps is harder to capture in one of these things, but maybe they can train it up so that it becomes quite a good implementer of its own philosophy, and that might be enough to make it worthwhile as an exercise. But I don't think it's going to discover anything that we don't already know about. We're all trying to buy cheap businesses ultimately that will will do better into the future. Where the future is like, that's part of the problem, right? How do we define what the future is? We might all think that it's. I'm not aware of any particular fundamental that's predictive beyond 5 years. Like basically your predictability is 0 at 5 years. Your excess returns in value, the bulk of your excess returns are in the first year, less in the second year, less in the third year. After 5 years, no excess returns. And value is the one with the longest tail of predictability for forward returns. So maybe it can figure out, maybe you can train it to find stuff that works over longer periods of time, but I just don't think it's possible, because the firms themselves change so much. Like, they raise money, they reinvest. After 5 years with a 10% return on invested capital, like a third of the money's been redeployed into a new kind of an extension of the business. And the reason that we can't predict it is because nobody knows where it's going to be. It's unpredictable.
Yeah, to your point, I mean, these fundamental databases have been beaten to death by humans before we had this stuff. So, the odds of finding something new, and these new systems are basically prone to the same problems we're prone to. Like, I could go run a back test tomorrow and data mine, and suddenly I've got companies that start with the letter C that have these random inventory to sales or something, whatever. You can. Yeah. There was actually an academic paper they did at one point where they did exactly that. It was funny. They just basically data mined it, and they came up with complete strategies that made zero sense that had like incredibly good performance, and they did it to prove a point. which is, we're all, yeah, I forget where it was, but it was very funny. Like the stuff that came out at the end made absolutely zero sense relative to like the value of the business, but it was all in there. So yeah, we're all prone to it. Like, and the computers are going to be just as prone to it as we are. Is like, this stuff has to make sense in the long term for it to work.
It's like that great joke that Buffett tells where the oil prospectus shows up at heaven and St. Peter says, sorry, we're full up on oil prospectors. And he says, oh, don't worry, I know what to do. And he shouts out, oil discovered in hell. And all the oil prospectors get up and get down to hell. And St. Peter says, hey, that was really clever. You can come on in. And he says, I don't know, there might be something to that rumor.
Are you still working on your book?
Yeah, I finished. I've got it out for editing and it's come back and I've just got to go through the edits. I've come up with a dummy cover. I just have to. It's in that awful period of time where it's finished and I can't look at it anymore. But I also think it's terrible, so I have to kind of will myself to publish it and get all of the, get all of the negative feedback. But I'm kind of. It's done. It's complete, and it's. I can't make it any better, even though it's kind of not quite good enough. Do you know that? You know that feeling where you.
Yeah, absolutely.
Whatever that's called. The uncanny valley or something like that, the worst place to be. I've been looking at Robert Greene, who's written some books that I really liked, and he says as soon as he finishes a book, he's like, it's done, it's gone. I never think about it again. Don't read reviews, don't read the book. On to the next thing. So I'm trying to adopt that mentality, but I haven't got it out yet. Yeah, it's almost ready to go.
For people who don't know, can you just talk about what the topic is?
Yeah, so I have read Sun Tzu. I read it in high school, and I've read it about every 5 years since, and never really could figure out why people liked it, because I thought it was kind of a Emperor's New Clothes thing. It was one of those things that you had to say that you'd read and understood, even though like it just didn't have anything in it. And the joke that I always say is like one of the things that he says is if you're traversing through marshy land and you're attacked, get your back up against some trees or something like that. And I was like, I never encounter anything like that in my daily life, so I don't really understand how it's helpful. But through COVID, I had a startup business, had little kids, and I turned 40, and so I had this like feeling particularly vulnerable through that whole period of time. And I read it, and for the first time, I sort of went, "Oh, okay, I understand now what he's talking about here." He's got this, if you absolutely cannot lose, if the downside is so bad that you don't want to lose, then this is the way to approach the problem. You just have to basically, he says, make yourself invincible, focus on defense. Here's what you need to do. And then and you can't kind of force opportunities. All you can do is wait patiently for those opportunities to appear and get good at assessing, asymmetric opportunities. And as I was reading through it, I thought, gee, this is a lot like Graham and Buffett. This is a very value sort of philosophy. And I went through and I grabbed all the most meaningful parts of The Art of War, and I compared them to the most meaningful parts of The Intelligent Investor and Buffett's writings. And I kind of wrote this book, and I tried to like lay out what I perceive to be Sun Tzu's philosophy and Buffett's philosophy. I don't think that Buffett has read Sun Tzu. I don't think that what Buffett is doing is Sun Tzu or anything like that. I just think that there is some way of surviving and thriving in chaos that Graham and Buffett have figured out that rhymes with Sun Tzu. And I think a lot of people are surprised a little bit. Like they think of Sun Tzu as being this very ruthless kind of Machiavellian character. And I certainly thought that too, until I read John Boyd, who's sort of well-known military figure here, who they say that he's like the greatest military mind since Sun Tzu, and he's delivered some briefings that I've also included in the book. And then there's another translation of Sun Tzu that makes it a sort of Taoist work, where the Taoists talk about understanding reality, understanding the way that the world is going to flow, and sort of aligning yourself with that flow. And so I think, and Boyd's point of view is that you should behave in a noble way, so that you pull away your enemies towards you by being noble. Like rather than destroying them, you sort of turn them into your friends. And so that sounds like a something of a naive thing to say, but the way that Boyd articulates what Sun Tzu is doing, I think I read all of that, and I think that that's part of Buffett's. Buffett doesn't pick fights. Like we talked earlier about Apple. And I think that, and I can include this in the book, there's a good analogy between the way that Einhorn and Einhorn took a run at Apple when they weren't doing a buyback. And they had these, they were hostile trying to get, I think it was just after Steve Jobs had passed away, and I think they were trying to get them to initiate the buyback. And they ultimately did force it through, and then they sold their stock and they got a little pop out of it. Then Buffett came in later. Buffett's taken a giant position in it, basically on the same basis that now they were doing the right things. They were already doing the buyback. And he applies just as much pressure, but he does it in a positive way. He compliments Cook. He does all of these things that he says they're doing a really great job with the buyback. You can see in subsequent letters, he talks about, when they do that buyback, we benefit because our ownership concentrates in. He's very, very good at applying the same level of pressure, but doing it in a positive way. And I kind of think that that's part of his success. And I remember that one of the things that attracted me to Buffett, I first read that Roger Lowenstein Buffett biography when I was a kid, and I was like 17 or something like that. And I found it to be a very positive experience because it was the first time that I don't know whether it's being Australian or what it is, but there's this view that a lot of business is, it's not honourable, that the way to succeed is to cut corners and be more aggressive or more ruthless than the next person. And that has no appeal to me whatsoever. I don't want to participate in a game like that. And I read the Buffett thing and I thought, well, you can do well by behaving well and doing the right things. And I think that that's Buffett's success. He's like, people want to sell to him and be associated with him because they like the way that he conducts business. He conducts himself in business. Charlie Munger's exactly the same way. Charlie Munger's more explicit about it. So that's the subject of the book. Sun Tzu says, sort of be a noble leader, do these things, behave in this way. And he talks about it in strategic terms and tactical terms. And so I tried to incorporate that into the book. So that's what the book is about. That's the very long explanation of what the book's about. It'll take you just as long to read it as it will to listen to my explanation of it.
How long is it?
It's short. It's I think it's like 50,000 words, maybe less than 50,000 words. It takes a long time to write a short book. I wrote the first cut of it was like 110,000 words. So I've cut every second word out. So as you're reading it and you're hating it, just think you could have read. Think how much longer it could have been before I edited it down.
I'm sure we'll love it. I look forward to reading it.
That sounds like a great book to me. And you just practiced your audio version of it with us, so we appreciate it.
There you go. I've got a great guy who does my voiceovers, so I think I'll go back to him. Although people want to hear me read it, I don't know.
I don't know. People like the Australian. I would go for it.
Is it I don't know if it's understandable enough.
Oh, I don't know. I think it'd be good.
I've heard it's really hard. I've heard trying to read you think it's easy to go read a book, and I've heard it's really, really hard to do.
Well, the good thing about reading it is you find all of the errors in it as you're reading it out. That's helpful.
Yeah, as long as you've done that before publication, right?
That's it.
Well, listen, Toby, thank you very much for jumping on with us. We wish you all the best with the book. We appreciate your, the support that you've given us over the years, the motivation, the inspiration, and, keep up all the good work with Value After Hours, what you and Jake are doing. And have a strong fall, and we'll keep in touch, man.
Thanks, Justin. Thanks, Jack. Always a pleasure. Likewise, thanks for all the assistance you guys have given to me over the years. I really do appreciate it.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.